With the specter of a double dip looming, Michael just referred to it, bonds are where the action is these days, and few people know it better than Brad Tank. He's the Chief Investment Officer and Global Head of Fixed Income at Neuberger Berman, where he oversees some $85 billion. Brad is in Chicago this morning. Brad, it has been an extraordinarily exciting time for bond investors. Forget about the equity investors who've been getting wiped out these past few days. You guys have been making, or at least the bond market has been making a killing. Can it continue?
Well, I think so. We've generally had a pretty good year to date in terms of bond returns. High-grade bonds up about 6% on the year. Even high-yield bonds, which have come under pressure lately, up about 5% on the year. And much to the surprise of many, one of the best performing parts of the fixed income market so far this year has been municipals, up somewhere in the neighborhood of 7-8% on the year.
Brad, yesterday we saw spreads widening on corporates, spreads widening on high yield. Is not perhaps a warning sign that maybe the rally that we've seen in the corporate world is coming to an end?
I don't think so. I think that we've clearly seen a sympathetic move in credit spreads in response to much of the weakness that we've seen in equity markets around the world. They do tend to move directionally in the same way, but the order of magnitude has been, of course, much less significant. In terms of order of magnitude, we have high-grade corporate spreads out about 25 to 30 basis points since May. High-yield spreads are out a little bit north of 100 basis points since May. And from our vantage point, through the middle part of this year, we had been moving up in quality, reducing some of our holdings in credit. We're poised to head the other way and take on incremental risk in the credit markets today. So we're an advocate at these levels with treasuries at 2.5% in the 10-year, roughly, and spreads, as I just described, of selling treasuries and buying credit.
Brad, what might happen today? Let's say we get a similar disappointment to the one that we had last month. Economists are expecting 85,000 jobs. Some of them expect less, some of them expect more. But if it's well below, what's going to happen to the bond market?
You'll see a continuation of the trends that have materialized over the course of the last couple of weeks. Weaker equities, wider credit spreads, stronger treasuries, and it's tough to place bets on 1 month's employment report. There's a lot of noise in the data, and we clearly have a disappointing situation at hand here in terms of job creation in the United States. The weakness in job creation, the weakness in income has led to softness in terms of consumer behavior, and that softness in consumer behavior over the course of the last number of months has been a big part of the global growth slowdown, which has been in place for the better part of the last few months. It's not just the United States.
It's great to see you here on the Inside Track. Brad Tank, he's the Chief Investment Officer for Fixed Income at Neuberger Berman. He oversees $85 billion bullish on bonds and not just treasuries.